Hello and welcome to Double Edge. I'm Govind Raj Echiraj. I'm joined by Duvuri Subba Rao, the former governor of the Reserve Bank of India and also author of this interesting new book, Who Moved My Interest Rate? Leading the Reserve Bank of India Through 5 Turbulent Years. Mr. Subba Rao, thank you very much for joining me. So let me ask you a very simple and perhaps straight question. If you were to take over as Reserve Bank of India governor today, which is September 2016, what would you say? And more importantly, what are the challenges that you think you would be faced with and how would you respond to them?
Well, certainly the balance sheets of the banks, cleaning them up, the huge non-performing assets issue, recapitalizing the banks, especially public sector banks, financial inclusion, all the various instrumentalities for that. I think I would also be thinking about institutionalizing this new monetary policy framework, the MPC, the inflation targeting framework. Of course, inflation targeting is already on stream under Governor Rajan, but now it's got a statutory backing. So how to embark on that without compromising on growth and financial stability, those would be the issues that'll be on top of my head.
And in terms of, let's say, seriousness, how would you compare today's environment, which is more internal, I would imagine, to 2008 when you took over, where, of course, there was a global financial crisis unraveling?
Oh, yeah, I think there's a big difference. Because in 2008, there was, as you said, the global financial crisis. Lehman Brothers collapsed 10 days after I took over. There was extreme uncertainty, fear, panic in global financial markets. It had an impact on us. We were completely unprepared for it because there was some sort of complacency in India that we decoupled, that whatever happens in advanced economies will not affect us. So I would say that between 2008 when I took over and in 2016 when a new governor is going to take over, the global uncertainty is much less. The known unknowns are much fewer. The unknown unknowns are much fewer. There is, of course, subdued growth in global trade, not growing as fast as global growth, etc. But the unknown portion of that is much less. So the shocks that can come from the external sector are less probable than they were at that time.
Right. So if we were in some ways insulated from the global financial crisis in 2008, is it, I mean, just to put things in context for someone who's trying to understand what happened then, and more importantly, whether it can happen again, is it because of accident or design?
I think it was design. Governor Reddy, under him, there was very prudential tightening of regulation, curbing excess credit growth in the housing sector, in consumer finance sector, and for investment in the stock market, etc. So I think it was not happenstance. It was because of the regulatory foresight of the Reserve Bank.
Right. So if you were to fast forward today, and some of these crises, financial crises, tend to occur in cycles almost. Right. What would be the areas that we should be alert on, and would they be the same ones that Governor Reddy was conscious about at that time? Would they be different?
They could be different. I wouldn't say crises, but there could be pressures. There could be pressure in the bank balance sheets that we are experiencing now. There could be pressure on the currency, which is much less probable because I think the rupee is fairly valued. There could be some marginal deviation from the fundamental value, but I think it's fairly valued. On the growth and inflation front too, there is growth is trending up. Inflation has trended down, but is now somewhat stubborn at not a very comfortable level. So I wouldn't say there's crises, but there are pressure points.
Right. So if you were to look more closely where we are today, and my first question to you was, what would you do if you were to take over as governor today? And you talked about bank balance sheets and recapitalizing bank. What are the lessons from this episode? Because all this is obviously built up over time.
Right. I think the lessons from this episode is to make sure that the loan books of the banks are clean, that if there is excessive credit growth in any one sector, we should be alert to that. And there have been some errors made in appraisal of this large infrastructure projects, especially under the PPP mode. There have been delays cost and time overruns because of factors beyond the control of the project implementers. I think we should build in some of them into the contract, and we should learn to do better contract management so that loans do not go sour.
And how would you see it from a regulator's point of view? I mean, how if you were to somehow have this foresight in perfect hindsight, how would you tackle this differently?
The regulatory forbearance that we gave for restructured loans, we should have, it's being withdrawn. The withdrawal started during my time and continued under Governor Rajan's time. We should make sure that there's as much disclosure as is necessary, that all
In the bank balance sheets.
in the bank balance sheets, all stressed assets are recognized and provided for. Even if that means that the balance sheets become weaker, it is better that they come out clean rather than give the perpetual impression that something is.
So would you say that maybe we've been a little lenient in the past?
I wouldn't say we've been lenient, but we did not anticipate the size of the problem. Okay, lenient would be the wrong word because we did encourage restructuring during the crisis. Actively encouraged. And when you're doing such a large size restructuring, it's quite possible some of the insolvent accounts too could have been restructured, whereas the intention was that only illiquid accounts would be restructured.
Would you trust the banking system to be transparent with its state of affairs?
I would think so, especially with the respect that the Reserve Bank, as the supervisor, commands. I believe that the banking system would certainly not attempt to hide anything away from the supervisors and thereby away from the market.
Right, and if you were to, let's say, create a more stringent framework for reporting and reporting stressed assets specifically, because Governor Rajan, for instance, has talked about a surgery, patient, operating table, all the idioms which suggest that the situation is dire. How, again, would you do it differently? Would there be?
No, it's difficult for me to contemplate on whether I would have done differently because I don't have the benefit of the inside knowledge or the analysis done by the Reserve Bank. But I believe that pretty much we would have done the same things.
Right, but would you also say that whether or not you were tougher, you would have faced a lot of pressure from the government to, let's say, go easy?
It's quite possible. It's quite possible.
And how would you have reacted if that was the case?
No, I would not have. I would have listened to the government, to their arguments.
Because they own 70% of the banking system in any case.
Not because they own 70% of the banking system, but because they're the government. Okay, you listen to them, see if there's any merit in their point of view, and if there is any merit to that extent, you take that into account. Otherwise, you make your own judgment. I'm saying that you don't necessarily change your point of view because the government has indicated a certain point of view to you.
Right. Okay, let me come to interest rates and growth. Right. So one of the points that you mentioned in your book is monetary policy can provide a conducive environment for growth to reach potential, but it cannot raise potential, which is the government's responsibility and supply side. And this leads to the larger conundrum, I guess. And you have industry constantly saying that we want interest rates to be cut, Reserve Bank holding on. It's a mating dance, if one may call it that. What's your sense today? I mean, is there a way to put this argument to rest?
I don't believe so because corporates, industry lobbies will always ask for lower interest rate. For example, I write about that in the book when I was having a meeting with 20 largest corporates in the country and they were unanimously pleading for a low interest rate. I said, okay, we'll cut the interest rate, but how many of you will make an investment decision in response to that softer interest rate in the next 1 month or 3 months? Not one hand went up, which demonstrates very clearly that interest rate was not the binding constraint to investment decisions. However, corporates want the Reserve Bank to soften the stance because they want to ride on the credibility of the Reserve Bank. If the Reserve Bank softens the stance, it is a signal that the economy is on the mend and that growth is picking up. And they want to ride on that trend. That's why I believe they want the Reserve Bank to take a softer interest rate line. Not because they're going to go and make investment decisions.
Okay, that's an interesting point. But is there, I mean, would there be sort of data, would there be insights which would somewhat conclusively show that either investment is driven by lower interest rates or investment is not driven by lower interest rates?
The Reserve Bank has done a study. I've requested my staff to do a study about the real interest rates and investment. There's very clear evidence that investment boomed in the pre-crisis years when real interest rates were actually higher than during the post-crisis years on my watch when real interest rates were lower. If real interest rate was the only binding constraint, investment should have zoomed in that post-crisis period as well, which is not the case. So there's any amount of evidence. You can go back to the RBI website and see the study.
Right. So if I were to ask you a slightly more global question, right? We are in a very interesting global situation where you have negative interest rates in some parts of the world, and here we are still relatively, obviously, high interest rates. How does this, to someone who's trying to understand, a student of economics, how does this, in a fairly interconnected world add up?
Right. But we're also not completely open on the capital account, right? So our interest rate regime, even our real interest rate, could be higher. It depends on our need for savings. We need to generate savings as well. So we need to keep real interest rates reasonably high. And we can't really compare interest rates globally from one country to another without taking into account the domestic macroeconomic circumstances.
Right. So let me ask you another question. If, again, coming back to the point that if you were to take over today, technology has made inroads into banking, perhaps more rapidly in the last 5 or 6 years than ever before. What are the positives of that? And some of that we already know. And could there be concerns as well?
The positive side, of course, is financial inclusion. It makes it penetration easier, less costly, more inclusive. It makes it simpler. For example, today there's tens of thousands of people moving from the northeast of the country for wage labor in Kerala, right?
As you mentioned.
And right, all of them are sending money back home, and that's made possible because of technology, because of awareness, because of smartphones, etc. That's been a big positive about it. And coming to a higher level in that hierarchy, there is fintech companies, peer-to-peer lending, etc., which are intermediation, which are improving financial intermediation. So all these are factors which are forces for the good. But on the negative side, we have to be wary of some loose practices developing, some groups of people losing money because of this, because of that sector not being regulated adequately, the fintech growing out of proportion.
Mr. Subbarao, in your book, there are 3 things that you've talked about as the future of a Reserve Bank and a central bank, I would imagine. One is setting standards, and in the sort of larger emerging market context. The secondly, you've talked about building a knowledge institution, and third, you've talked about deepening and widening financial inclusion. You've already touched upon financial inclusion and what you would see or where you would like to see it go. Talk a little bit about the setting standards. I mean, what's your vision there?
I thought that making monetary policy, making regulatory policies, making payment and settlement system policies will be, there's the degrees of, not the variables are many more, uncertainty is much more. The Reserve Bank needs to understand what's happening and the implications of what's happening on our system and make policies for that. That's
right.
The first thing I said.
Right. And you also talked about building a knowledge institution. One illustration of how that would pan out.
Well, a knowledge institution, for example, would be, let's say negative interest rates in Japan, in Europe. What does that mean for us? What does that mean for capital flow? Okay. A knowledge institution, for example, on virtual currencies. What does it mean for the efficiency of monetary policy? Do we have to tweak it? At what point of time do we start regulating it? A knowledge institution in terms of all this fintech that's coming around. Okay, drawing the right balance between encouraging innovation, but at the same time safeguarding interests of individuals, consumers, etc. All these are variables that the Reserve Bank has to take into account.
Right. So last question. So you started as a district collector in Parvatipuram, Srikakulam. Sub-collector in Andhra Pradesh in the 70s. If you were to go back there today,
Yeah.
what would you see and or what are you likely to see today and what would you do?
You know, I'll be fascinated to go and see all the tribal tracts that I had visited 35, 40 years ago. We had to walk about 3, 4 hours, 5 hours to reach hamlets, tribal hamlets. Today I would imagine that there are motorable roads, that tribal children are well educated, more healthy. Tribal girls especially are more healthy. And all of them, even adults, whether they're literate or illiterate, will be using smartphones. You know, making reservations for bus, train journeys. They would have, I would have seen them having greater exposure. And if I talk to girls in some tribal elementary school, I believe that at least some of the girls will say, if I ask them what's your aspiration, some of them will, at least some of them will say we want to be pilots, we want to be astronauts. Someone might even say we want to be governor of the Reserve Bank of India.
And therefore there's a long I mean there's much to do. I mean it's not
There's
just
much
for the
to do, and sometimes my concern, agony is whether Delhi and Mumbai understand the realities of the vast country that India is.
100 rupee note,
Yes.
which has your signature in any case.
Do I
To
endorse
see
it
among
to-
other things whether your signature has remained consistent. You've also signed in Hindi.
Yes, and my Hindi signature is more legible.
But do you think this signature is matches this?
That's for you to judge.
Okay, thank you.